I'm Charlotte McLeod with investingnews.com, and here today with me is Don Durrett of goldstockdata.com. Thank you so much for joining me. Great to have you online once again.
Hi, Charlotte. Thanks for having me back. The one thing, you're wearing a green sweater. It matches your green eyes. I don't know if you noticed that. You're one of the few people that have really distinct green eyes. I mean, it's unusual. And then you wear that green sweater, and it's like they kind of pop out.
Oh, thank you so much. I didn't try to coordinate, but I guess it sometimes happens like that. So really good to be talking with you again. And, our last conversation was a few months ago. And at the end of that interview, you mentioned the upcoming BRICS meeting. And we kind of decided at that point, we had to come back together and talk about that once the meeting happened. So the meeting has now wrapped up, and I want to get your thoughts on what we saw there. I think as we were talking before we started, one of the big announcements to come out was the addition of 6 countries to the BRICS. So let's start there and hear from you about the significance of that move.
Well, a lot of people thought, this was going to be a nothing burger announcement, but I looked at it as, I thought it was a 50-50 chance they'd announce the currency. Turns out they didn't. Well, I think it's over. So I don't think they announced anything about a new currency. That was very disappointing. However, they added 3 large oil producers: Saudi Arabia, Iran, and the UAE, United Arab Emirates. So those 3 countries, when you add those three to Russia, it's a large. Those are the biggest oil players there are. And Nigeria wants in. They're another big oil producer. So I think that the reason why the stock market fell today, because it should have went up with NVIDIA's, great numbers, but it didn't. I think the stock market, who has been ignoring this whole BRICS expansion, the impact it's going to have on de-dollarization now because of all that oil. Oil is the number one exporting revenue-wise. So if these countries are basically going to say, pay me in non-dollars, and I think that's what we're going to see, then you have this, this end of the petrodollar, and the dollar slowly, loses its value over time. I think this is kind of a historic event. I did see it as a win-win. This BRICS conference is a win-win for gold. It's either going to win with announcement of a possible currency. That would have been huge for gold. Gold would have went up probably $50 a day if they would announce that. But by announcing this expansion of 6 countries, I think that's the beginning. They're going to keep expanding after that. And there's another, 35 countries that want in. And as those countries come in, that's going to slowly, create this de-dollarization effect. We don't know the overall impact it's going to have to the U.S. economy, but I think it's detrimental. I really do. I think the end game is going to be detrimental. And the stock market, I think, is going to start to feel what's coming. It's like, we got a problem here. The U.S. has been the global leader. I call it global dominance since the end of World War II. We've basically been able to control the rules of international trade. I mean, the SWIFT system only uses the U.S. dollar. And the SWIFT system is what has been used for international trade. And so now we're going to start to see, it's inevitable, I think, that they start to use a different system than SWIFT. And when they use a different system of SWIFT, they're going to use other currencies. And that's going to slowly move a movement away from the dollar. And I don't think Russia is done and China is done with this idea of creating a BRICS currency. I think they both want it. And one announcement that was made, the only one I really saw that was kind of, let's do a currency, was out of Brazil. De Silva, he basically said we need a separate currency, not to replace ours, but we need a separate unit we can use for trade. So he was the one guy that said something. Other than that, it was quiet. But so it looks like Brazil and China and Russia all want one. And so I think we're going to hear more and more rumors about it. And so if they don't create a BRICS currency, it's not going to happen overnight. Might not even happen, for a year. But if they don't create a new currency, I don't think that China wants the yuan to be this global reserve currency. They don't want a lot of countries, using the yuan as their reserve. They don't want, that's the kind of a mess they want to avoid. And so I think, so both China and Russia, I think, are going to push that. So if we don't get this idea of a new BRICS currency, I think what's going to happen is they will use a digital token, a blockchain token that's backed by gold. And I think that might come out of Iran, it might come out of Russia, where they create basically a crypto digital token that's backed by gold, and they use that for international trade instead of Bitcoin, if you will, because they feel that Bitcoin's too volatile. But if we use the gold-backed digital currency, so I think, and that's actually going to be bad for the dollar as well, because if you're using that, you're not using dollars. And then the one thing, if they do something like that, that could work for their trade with Europe, Russia's trade with Europe, who don't want to use rubles. So this whole BRICS currency thing is not over yet, but the downfall of the dollar, I think, is just sped up a little bit, which is going to, I think, create a bad problem for the U.S. economy going forward.
Yeah, and moving forward, we'll touch on your outlook for the U.S. economy. But first, I want to play a little bit with that concept of de-dollarization and get your thoughts there a little bit more. So you mentioned that maybe this is sped up, the de-dollarization, but what does that actually look like? Because I've heard various ideas about de-dollarization, whether it's happening quickly, happening slowly, the things that are urging it along. To you, what does that process actually look like? And then what is the end result?
So what it looks like initially, is going to be more of this bilateral trade agreements, where you basically say, instead of using dollars, we're now going to use rupees. Instead of using instead of using dollars, we're going to use rubles. So it's basically, we start seeing more bilateral trade agreements. So that's kind of a really slow thing. The second thing that can happen is that countries, and two countries to really keep your eye on in this regard, is they basically stop buying U.S. treasuries and start selling them. And the two countries to keep an eye on who have already started doing this is China and Saudi Arabia. If you look at what their all-time high was, and look at the trend has been down. So those two countries, which have a lot of money, right, if they stop buying U.S. treasuries, that'll put pressure on the dollar. So in the near term, the two big factors are these bilateral trade announcements and a lack of buying of treasuries. Now, the one thing that I've been predicting for a decade now is that China and Japan are basically going to have a game of chicken about who's going to sell their U.S. treasuries first, because I firmly believe that the U.S. cannot pay back all of their debt. So at a certain point, the U.S. is basically going to do a partial default. They're not going to default on 100%, but they're basically going to say, sorry, Charlie, we can't pay you back 100%. We're only going to pay you back 70% or 60%. That's considered a reset. And I think China and Japan both know it's coming. And the reason why is because the Fed cannot monetize 100% of our debt because it'll destroy the currency. They can monetize, we don't know where's the line once they get so high that the dollar starts creating a hyperinflation. The Fed knows this, that they can't monetize it all because it's all printed money. So if you have a budget deficit of $2 trillion, it's almost, 150 billion a month that you need to print. So at a certain point, you can't. And so that's coming. So that's this game of chicken. So China and Japan, who hold the biggest amount of our treasuries, at a certain point, when they see this, when they see that the Fed is monetizing too much, one of them is going to get out first. And that's the game of chicken. And I've been watching China. Once China gets under 700 billion, 700 billion of treasuries, once they get below that in holdings, at that point, Japan has to start saying, wait a minute, we cannot allow them to get out first, and then we're holding the bag. So that's the number. So 700, 600, 500, somewhere in there between, I like to make these, these predictions, these ranges. So somewhere between 500 billion and 700 billion, somewhere in there, I think it all breaks. I think that Japan basically says, we got to get out, because if we don't, China's going to get out first. And that's that game of chicken. So that's something we have to keep an eye on. Now, that's not going to happen in 2024. I think 2025, maybe 2026. I think the reset's coming in 2027. That's when the U.S. basically throws in the towel and says, we have to do a reset. We can't monetize all this debt. Can't do it anymore. Come to the end of the road.
Okay. And meanwhile, we have this BRICS currency. So you talked about how we didn't get that announcement this time. It seems like maybe the BRICS countries aren't really all unified on that, at least not yet, although some countries do want to have it. So I do want to talk a little bit further about it, though, because it's really interesting. And I think people have a lot of questions about how it could actually work. We've heard that maybe it'll be backed by gold. Maybe it will be backed by another commodity somehow. Maybe it will be linked to gold versus backed, which is another distinction. So can you talk a little bit about what you think could be coming, keeping in mind that we don't actually know very much yet?
Right. So the reason why BRICS currency was not discussed here is because it works only for those who are exporting. It doesn't work well if you're importing. And India has been very adamant that they're not behind this because they're an importer. Here's the problem for India. India will have to purchase BRICS because they can't use rupees. So when they purchase those BRICS, I mean, whoever receives those rupees is going to say it's going to be a hot potato. It's like, okay, here's $20 billion in rupees. Give me 20 billion in BRICS. Yes, the BRICS currencies are going to go up, which is great. But simultaneous to that, whoever receives that 20 billion in rupees, that's going to be a hot potato. They're not going to hold on to it. They're going to immediately dump it. So what is that going to do? It's going to put downward pressure on the rupee. Same thing with South Africa, same thing with Brazil. You know, it's great for China and Russia because they don't have to buy any BRICS. You're going to give me BRICS, which is great for them because when all the BRICS that they get, those BRICS are probably going to go up in value. So China and Russia are like, this is great for us. And India's going, this is screwed for us. So I think the only way that they're going to do this is, and Jim Rickards brought this up, and I agree with them, is they're going to have to link it to gold. So if you link it to gold, it's real easy to price. So it's like, okay, the one BRICS unit is worth, 1 gram of gold. And it just floats that way. You're right. It's really easy to price. In 24, basically the BRICS currency is priced 24/7. It's a lot more difficult to price it if you add currencies or you add commodities. It gets really messy. So the simple way to do it is to link it to gold. And then you don't have to back it 100%. You don't have to make it convertible into gold. Forget all that difficult stuff. Just link it to gold into story. But again, the problem and the reason why we might not see a BRICS currency is because it's really bad for countries that import stuff, which are going to be a lot of these BRICS countries that join. A lot of them are importers. And so if you're an importer, I mean, Argentina has just joined, for instance. They're an importer. They do export, but I could be wrong here. They export a lot of food. I don't know what their net is. But some of these countries are going to be net importers that need a lot of energy. And that it's not, and the BRICS currency it's not great for them. And that's the reason why they didn't talk about it. Is because India is so against it. It's like, don't even mention that thing. I don't even want to talk about it. So they were nice to India here and didn't talk about it. But they will talk about it. And China and Russia still have a problem. They have to figure something out here. And they're going to end up having to bypass India here. India basically said, good, create one. We're not using it. That's what they said. And I just explained why.
Okay, I think that adds really a lot of helpful context there. I certainly learned a few things. And so, this may or may not happen as you've just explained. I wonder if this BRICS gold-backed or gold-linked currency does go ahead, is there an impact then on the price of gold?
Well, it's kind of a non-starter, right? Because that we're not going to get this BRICS currency anytime soon, and so until we get closer to that effect, we can't really kind of price that in to gold. So it's going to have a huge impact on gold if it happens. This is where gold goes from 3,000 to 5,000. But to get to 3,000, we don't need a BRICS currency. We already have plenty of reasons why gold's going to go to 3,000. The BRICS currency just pushes it higher. So I think this question just all it needs is a succinct answer, and I think that covers it.
Okay, I think that's also a good way to look at it. So thanks for going over that. So we've been talking about, things that are maybe happening in the far out future, not right now, but let's hone in on what's going on right now. You had an interesting tweet the other day that we're going to look at. And basically, we'll put it up on the screen for people to see when we post a video. So you said this recent 9-month stock rally is based on fairy dust. This is a dead cat bounce. You don't see this lasting. So let's talk about what you were getting at in this tweet and some of the predictions that you have in the near term.
Yeah. So yesterday or the night before last night, I had basically an epiphany that this 9-month run is over. And I just don't think the stock market's going any higher because there's just so many negatives. There isn't enough positives to get this market to go higher. We had a 9-month run here. It's like, how much further can it go? Is a 5% correction enough? Is that enough for the stock market? We've already basically had one here. And now it's going to bounce and start running again. It just doesn't feel right to me. So I mean, I like to look at everything, all the data, including history. And so for me, if I go back, I can go all the way back to 1970, but now I'm just going to go back to the year 2000. I firmly believe that in the year 2000, when the dot-com bubble busted, that the U.S. economy basically came to a halt, if you will, to grow on its own. It was basically forced from the year 2000 forward to basically grow through basically a managed economy through low interest rates and money printing. So we saw the U.S. debt jump from, I don't know what it was in the year 2000, but I think it was about 3 trillion. That's my guess, maybe less than 3 trillion. Today it's at 32 trillion. So we've basically been living off of this debt for 23 years. And I think the economy was fundamentally damaged after 2000, and we basically have been faking it ever since. That's why I said this last rise is not based on fairy dust. It's just based on the idea that we can basically manage our way higher. And I think that the Fed now, because of inflation and because of the damage to the economy through COVID and because of the damage to the economy through basically mispricing assets, when you have low interest rates, you create a lot of mispriced assets like housing. I think housing is mispriced because we had these zero interest rates. People could get a mortgage for 2.5%. And it really increased the price of housing. I mean, we have, new houses, you're lucky if you can get one for $400,000. We got a mortgage of 7%. How many people can afford that? So we got a big problem with our housing. Autos, you're lucky if you can get an 8% loan. Average car is $40,000. That's $3,000 a year just in interest alone. Who can afford, these things? And so the economy is damaged, I believe. It's not set up to grow. So you got the Fed going into Jackson Hole. I think it's going to be a hawkish speech. I don't think he can basically put his foot off the gas here because he basically needs two things in order to get his manipulation. He has to have the ability to lower rates back to zero, basically. He has to have that ability to do it. And he has to have the ability to print whatever he wants to. He has to be, and so until now, the Fed has been able to do kind of whatever it wants proactively. Now they're in a reactive mode. I don't think people realize the significance of that. I think everything to me is just building. It's just building. People say, well, last year, and I'm actually, in my tweet, I'm basically predicting the same thing's going to happen that happened last year. He had a hawkish speech out of Jackson Hole, and the stock market crashed in September and October. I think the same thing's going to happen. I think if 4,200 doesn't hold on the S&P, 4,200 is a really important technical number. That's the number that we couldn't get above. It took a long time to get above it. And then once we got above 4,200, and immediately it ran to 4,600. That was, and everybody thought, oh, good, we're in a bull market. And to me, that was just like that last dead cat bounce. And now we're back at 4,400. And so where do we go next? Do we go to 46? Do we go to 42? Does 42 hold? My feeling is that in September, we go and retest 42 and it doesn't hold. And then once you get below 42, the fear really starts kicking in. And I think we crash in October. Now, I know October is the month, the bad month. We do always see those crashes, but everything's going to be set up for October crash. I mean, we have the savings problem with the consumer. Everybody, people are going to have to start paying their student loans back in October. You have high credit cards. People are tapped out. So the consumer is going to start to take a hit. I think we're going to start to see mass layoffs. And so there's nothing really positive here for September and October. And so can we hold 4,200? My gut says no, it's not going to happen. So September, October to me really, really look like a train wreck. I could be wrong, but everything that I'm watching points to problems. Now, the one thing that Wall Street is just ignoring is this whole idea of a lag effect of high rates. We went from 0 to 5%. We haven't seen the lag effect yet. In other words, Atlanta GDP now, they just bumped their GDP up for third quarter to 5.9%. I'm not buying it. It's not great. When back in, I think early August, when they took it up to 5%, I was like, oh no, the economy's good, consumer's good. But the more that I look at the data, the more that I watch what's actually happening, I'm just not buying that number. The overall consensus is 1.8%, but even if we're growing at 3 right now, I think that 3% could go bye-bye in a heartbeat, because once the stock market crashes here, that is when your layoffs begin, and your jobs market is the last shoe to drop. And so the stock market gets under 4,200. I think it goes under 4,000. Once you go under 4,000, there's going to be no buyers. Everybody's going to be looking at the correction low, which is 3,500. So if you slip under 4,200, you slip under 4, and then the magnet is that low that, we're going to go retest the low of 3,500. And everybody is going to be scared to death. We're going to go retest that thing. And that fear is going to be really hard to overcome, because the Fed is not going to be coming to the rescue. The Fed's not going to lower rates or start talking dovish just because the stock market goes to 4,200. They're going to be happy that it goes to 4,200. And so there's nobody coming to the stock market's rescue here. And then the BRICS just unfolded this whole idea of de-dollarization, which is another big, headwind on the economy. So as of today, I'm not even 80% sure the stock market's going to go under 4,200 in September. I'm more like 60, 70%, but I'm above 50. If I look at things from a perspective of 50-50 chance, am I flipping a coin here? The way that, game theory basically says is that once you're above 50%, that's where you bet. And right now, my gut feeling is not way, but above 50%, 60 to 70%, that 4,200 gets taken out in September. Maybe it gets taken out in October. I have to watch what happens in September. Everybody keeps saying, I keep rolling this forward. And, I hear you. I'm the same way. When I see somebody keeps saying, this is going to happen, and it never does, I get tired and I stop listening to the guy, right? But people that have listened to me know that I've basically been called the most bearish bull, the most bearish gold bull out there, because I kept saying over and over again, gold's going down, it basically never did go up. It never broke out. I mean, I've been in this 18-month, gold is trapped for the last 18 months. So here I am, this gold bull, but I've been bearish. And the reason why I've been bearish is because of what's happening here, because of this hangover of the stock market. Until that stock market capitulates, until Wall Street throws in the towel and basically says, okay, we're going to have a hard landing. Until that hard landing arrives, gold has a problem. Gold can't go anywhere. It's trapped. And so I see this final correction here, but I think that gold is going to bounce. Now, this is where I'm a little more bullish than other people. Some people say that gold's going to go down with the stock market here. But I say that it's not going to go all the way to the bottom here. what's going to happen, in my opinion, is that gold's going to bounce somewhere around between 3,700 on the S&P and 4,000. Hopefully it's closer to 4,000. In other words, I think the stock market going all the way to 3,000, but gold's not going with it. I think gold will bounce somewhere between 3,700 and 4,000. Now, why will gold bounce? I think it will bounce because of fear. The fear trade will reignite. And once that fear trade reignites, gold's going to start trading higher and it's going to decouple from the stock market. So that decoupling, for me, the important number I'm watching at is 1,800 to 1,825 on gold. I expect 1,825 to get tested here, but I want 1,800 to hold. So the only way 1,800 holds is if we get this decoupling and gold bounces. And, I'm crossing my fingers and praying that it does bounce and it doesn't just follow the stock market down. Some people on the other side of the coin, they think that gold's going to hold. It just went down under 1,900. And people thought 1,900 was going to hold. I said, no way it's going to hold. And it didn't. And I don't think 1,900 is going to hold here when the stock market goes down. The one wild card that I said was if the BRICS announce a new currency. That's the wild card. They didn't. They did not announce they're working on one. So the wild card didn't happen. So that's bad for gold. So now gold basically says, uh-oh, I got to find a bottom. I got to find a floor. Where's it going to be? 1,870, 1,850, 1,820, 1,800. I think it's going to be somewhere between 1,800 and 1,825. So, and I think we're going to see it in October. Maybe I'm wrong. Maybe it goes to November, December. But I do think that gold will bounce this year. And once it bounces, everybody's going to be running to gold because they're going to recognize that the bottom is in. Now gold's going to break out.
Okay, I really appreciate all the different levels and numbers that you're giving. I think it adds a little bit of precision to what we're talking about. One thing that I'm curious to hear more about is where you think the Fed will be going during all of this. So you mentioned the Fed has become pretty reactionary, and we're going to have this stock market problems that are coming up in September, October. And I've heard some people say, we're going to run into problems, and that's when the Fed will step in and help. But then you were saying kind of the opposite, and they're going to stand back. They want to see this happen. So for you, what's the trajectory looking like for the Fed in the months to come?
Yeah, a good question. So the Fed wants its tools back. And the only way they get their tools back is to get inflation under control, because those tools are what they're going to use to prevent this economy from imploding. Their number one mission, in my belief, is economic stability. It's not inflation. It's not full employment. It's economic stability, financial system stability, economy stability. That's their number one priority. And to have that priority, they have to have their tools in order to control it. So no way does the Fed, if the stock market goes down to 4,200, are they even going to think about coming to the help of the stock market, if you will? You still have the GDP growing. Now, sub 4,000, once we get below 4,000, there's going to be a lot of people screaming at the Fed. You can't allow us to go back to that all-time, that 3,500 level. You got to come and help us. I don't think the Fed is even going to be interested at 4,000. I don't think they'll get interested until sub 3,700. Remember, that's 37, 38. I think they might think about it, but I don't think we're going to see some emergency session where they're going to lower rates just because the stock market is at 3,800. So I think the opposite is true as we speak. The opposite is that right now the Fed's thinking of raising rates. That is basically their mindset. And that's what I think Powell's going to say on Friday, is that we might not be done here. We might need to raise again. I think it's going to be a hawkish space where they're actually leaning towards raising, not leaning towards cutting. But that said, I think that once the stock market does get below 3,500, somewhere 3,700, 35, somewhere in there, I think that the Fed basically at that time will probably start to make announcements that our next move is down. And I expect to see a cut before June. Some people say, we're not going to see a cut at all next year. I expect to see them to begin cuts between, October and June of next year. I'm expecting to see a cut. And when they do cut, it's going to be great for gold. It's going to be bad for the dollar. And when they do cut, it's not going to be because inflation is down. It's going to be because the economy's in a mess. The hard landing has arrived. So the first cut that they make is actually going to be, really good. I think that gold will be above 2,000 when they make that first cut, and after they make it, it's going to be amazing for gold and miners, because at that time when they make that first cut, everybody knows this is great for gold, bad for the dollar. So you're going to see gold go 2,300 right around there. So I'm waiting for them to cut, but it's possible they cut this year if the stock market crashes. But right now, I'm thinking the first cut's going to be first quarter next year. But everything, the Fed's in trouble. I hear. I really feel that way. They're trying to thread the needle. They're trying to, get their tools back and not let the economy crash at the same time. When has the Fed ever gotten it right? Never. You could say that Volcker got it right. And I would kind of agree with that. But other than Paul Volcker, you can't really point to anybody that has basically said, okay, this is what we're going to do to accomplish this, and then pull it off. I mean, you could say Bernanke, but what he did by cutting rates in, 2000, 2001, after that recession, that period, yeah, he got the economy back going again. But what did he do? He created that huge bubble. That bubble that we're now, experiencing again, the housing bubble. And then now we're experiencing another housing bubble. And so, we went into bubble land, basically. He didn't allow the economy to reset, which is what he should have done. He basically started to bring in MMT, which allowed the free markets basically to break. And so the Fed has broken the free market. And so now it's just going to be bad outcomes from here forward. And 2024, I wanted to talk about this. So in my tweet, I said that, this is the third shoe to drop. So in 2016, I think that is when the political system broke. When Trump came in 2016, nobody really thought in terms of we can work with this guy. It's basically the political system broke. That both parties basically went in different directions, and simultaneously, the mainstream media kind of basically thought that Trump was the Antichrist as well. And CNN was like just daily, this guy's the Antichrist kind of thing every single day. And so our political system broke in 2016, and then in 2020. COVID came, and both our healthcare system broke and our institutional confidence broke. Now the average person no longer believes what the government tells us. It's like it's just one lie after another. And that song, the rich men are north of Richmond, that thing hit a chord because people are like, we can't trust people anymore. They have the government and our institutions, they're out to get us. They're not out to save us. And so we basically have given up. So it's kind of a double thing, but it was like the political system kind of broke in 2016, but in 2020, it's like everything broke. The institutions, our institutional confidence broke. Now in 2024, this next year, I believe, is the final shoe to drop. And that final shoe drop is basically the economy breaking and the Fed losing its ability to, manage the economy, and America losing its dominance in the world. So I think by the end of 2024, we will come to the recognition that the American era basically came to an end. And now it's just a matter of, what comes next. So we're going to get, by the end of 2024, we're going to come to the realization there's only one way forward, and there's only one option, and the other option is we have to do something different, and that's going to be really, really weird, because when we start to do something different, I mean, that's a big word, and that's what's going to happen. We're going to, and it's going to be kind of, you think craziness was from 2016 to 2023. You think the last 7 years have been crazy. You wait till 2024 to 2028. It's going to be crazier.
Wow. I think definitely I can see the dominoes lining up when you explain it that way. And I don't know if I'm personally ready for more craziness, but it sounds like that could definitely be where we're going. So I do like to, when we're talking about all these big events, I do like to connect it back to what investors can do to prepare, how they can get ready and protect themselves in these scenarios. So you mentioned earlier the gold stocks and how they will be hopefully performing well when we see gold take off. But before we turn the camera on, we're talking about the performance this past summer, a little bit of capitulation and disappointment from investors that we see online. So I wondered if you could talk about the gold stocks, how they have been doing and where they are going.
Yeah, that was actually two questions in one. I'm going to leave the
Yes.
answer for the second part. First part is I want you mentioned, what do people do? So when Japan hit its wall in 1989, their stock market was at 37,000. It's how many years later? 30 years later, and we're still not back to 37,000. They hit a wall, never got past it. The U.S. is about to hit their wall. And I think the same thing's going to happen here. I think that, we're going to look at that 4,800 on the S&P, and we're going to be looking at it for the next 2 years, at least, is my feel. I think we're going to end the year sub 3,500. And, 1,000 points up is not going to look pretty going into a recession in 2024. So we're going to hit our wall here. Might have hit it today with this announcement by the BRICS. And so that means if we're going to hit our wall, where do you put your money? Where do you make money? I think that, interest rates are going to go down here. And so, bonds, net money is, bonds aren't going to be a great place to make money, I don't think. Now, initially, when interest rates, if you own bonds now, and initially when interest rates go down a little bit, like I do see, when they start cutting rates, when the Fed start cutting rates, I do see the 10-year going below 3%. So if you own bonds, you're probably going to make money as rates go down. But once those rates go down, that's going to hurt your interest income, right? So then people are screwed. I can't get money on interest. I can't get money in stocks. Where do I make money? So it's going to be difficult to make money the rest of this decade. Now, for me, I'm a speculator. So gold and silver mining stocks and gold and silver and commodities, those are the only places that I like here going forward. Commodities are the safer place to play. You got to do your research on how you play the commodities. But I mean, Michael Oliver last week, he had a podcast and he had this great chart about, the commodity kind of index, where it was in 2008. It had, where, kind of where it's going here. And I agree with him. I think the commodities are going to do extremely well this decade. I think oil might go down in the 60s here initially when the stock market goes down, but it's going to bounce fairly quickly because oil production and oil exports are really starting in 2025, are really going to have trouble here, kind of hitting, the global demand, what global demand versus what you can supply. I really think that, I don't know, I think 2024 is okay for oil, but 2025, 2026, I think oil prices are going to really explode. And when oil prices explode, that's going to push up all the commodities. So I think we have maybe 12 months, somewhere in there, where inflation is kind of under control and commodities are kind of under control to a certain extent. But that's it. I call this the end of Easy Street. We still are on Easy Street to a large extent. Now, as 30% of the families are struggling right now to pay their bills, something like that. But 50% are doing okay, and 25% are doing great still. Though, 25% are still on Easy Street, if you will. And I think that our way of life today, the way that today, as it currently exists, I consider that Easy Street. And I think we only have about 12 months left of that. And then things kind of get nasty. And so that's when, interest rates start going down, but simultaneous to that, we start to see higher inflation through commodities. So it's like now the Fed, this big mess of inflation, can't lower rates, we're monetizing the debt, no economic growth. It's, we really only have, I think, only about 12 months. And I think the stock market is going to smell this out. And that's why I think the crash is going to happen here in September and October. It's kind of sees what's coming. And the stock market is going to be way kind of ahead of the curve here, probably 12 months ahead of it instead of 6 months ahead of it.
Okay. I think that adds some good context. And thank you.
I'm sorry. I'm sorry. I didn't answer question number two. Can I answer question number two?
I was gonna ask
What's,
about the gold stocks
what's
and
going
make
to
sure we
happen to the
cover
gold
the.
stocks?
Yeah. Okay.
Okay. This is the reason why I'm in the gold and silver space and the mining stocks. This is why I'm in it. If you look at where the mining stocks are right now, they're incredibly cheap. There's only, in my database, there's only 20 silver producers, companies that consider themselves silver miners. 20 producers, that's it in the world. And there's not a single pricey one in the bunch. They're all cheap. It's kind of insane how cheap these miners are. So I'll start with silver, because silver is so cheap. It's at $23 on the spot price right now. And so, half of the silver miners are losing money at 23. Half of them are making money, something like that. Of the 20, maybe 10 are making, 10 are not. But the 10 that are making money, only about 3 of them have some decent margins. 17 are struggling basically. So once silver gets to $30, and the reason how it's going to get to $30 is this way, is that silver just comes along for the ride. You can ignore silver price, ignore what pushes silver. You can just focus on gold. When gold finally bounces and gets above 2,000, silver will bounce and get above 25. Once silver's above 25, it will not take long to get to 30. My feeling is that'll take less than a month, which is kind of insane. And the reason why is because the technicals are silver's just so far behind, lagging so far behind gold. Once silver finally decides to move, boy, it's going to be a rocket ship. And so once silver gets to above 30, I said 20. So the reason why I say it's a month is because once it gets above 25, the key number levels are 27, 28, and I think it's going to get to 27 within a month. Once it gets above 27, it's just going to be, $3 move from 27 to 30 in one day. It's going to be kind of shocking to people what's going to happen here. Then once silver gets above $30, it will get above 50 within 6 months, and it could be within 3 months. So once you get above 25, you're looking at silver getting to 50 within 6 to 7 months, which is absolutely insane, because if it does that, all these silver miners that are just super, super cheap are going to be rocking and rolling. Their stock prices are just going to go absolutely bonkers. And at that point, people are going to start jumping into the market because they're going to see these stocks going up 10, 20% in a week. And they're like, this is easy money. And so everybody's going to be jumping into them. And then, and gold's going to be, when silver's doing all this, gold's going to be leading. And so silver's going to be going nuts, but they're not going to be leading. It's going to be gold that's going to be leading. And so the gold miners are going to be doing as well, but they're not going to be going up as high because they're not, we got $1,900 gold. So their margins are, $400, $300 to $400 already today. So their margins are already pretty good. So there are a lot of gold miners that are cheap, but most of them aren't super cheap. They're not going to run, as fast as these silver miners, but they're still going to do really well. I mean, you got a company like Newmont trading, I think it's around 42. I'm not sure, but if you look at where it was in October, in August of 2020, it's lost all of its gains. So in other words, it's going to have a 100% run just to get back to its October gains. And then it's going to do another 100% run to get to 2,500 and another 100% run to get to 3,000. So Newmont's going to be do a 300% return. Now I'd say 200 to 300% return to get to 3,000. So that's one of your biggest gold miners in the world. If Newmont's going to go up 300%, you can imagine what the mid-tiers and the juniors are going to do. It's going to be kind of crazy. I mean, the mid-tiers are going to go up 400 to 500%. The juniors are going to go up 600 to 1,000%. It's going to be crazy. And nobody's really expecting this. The sentiment, Hecla went down to $4 because they had a fire at one of their mines. But that fire is not going to stop them from restarting the mine. Everybody's thinking in the short term. That's all going to come back. They're all going to come back in line. You shouldn't even be owning miners if you think in the short term. You should be thinking 24 months out. So it's like, so what if they have a problem today? In 24 months, their free cash flow is going to be huge. And You should be thinking about future free cash flow, not future free cash flow this quarter. But Wall Street's controlling the price, and they only care about this quarter. They only care about the next quarter. So prices went to $4, but that price action showed you how sentiment is terrible. I thought that it would jump to 450 the next day, but guess what? It didn't even bounce. It stayed at $4. But then yesterday, silver went up 3%, and then Heckler went to 450. It's probably trading around 450 today. So anybody that bought at $4, they got, great entry price. Now, when we get this final sell-off in the next 2 months, I'm saying that's what I'm expecting. Heckler will probably go back under $4 because everybody's short-term minded, and that will be a great buying opportunity. So I personally like to buy dips. Some people like to only chase the Momo. They only want to make money. I have no problem buying dips. And a lot of times when you buy dips, you're catching a falling knife, but you're also getting in lower than people that are waiting for the Momo. If you're waiting for the Momo, you're not going to buy Heckler at $4. You're probably going to buy it at 5 or 6 or 7. And if you buy it at 5, 6, or 7, you're not going to get a 10-bagger. You're not going to get a 5-bagger. If you buy it at 4, you got a good chance of getting a 5-bagger and a potential get a 10-bagger. So you've got to, entry price is everything in miners, in my opinion, for big returns, if you're after the big returns. So I personally like to buy to the bottom. I think the HUI is going to go somewhere between 195 and 205. It got down to 214, which I thought, great. That's where you want to be buying. Now it's bounced back to 224. So it's just under 223 today. So it's just under that 225 level, which I consider the buy area. So I kind of I don't like to buy above 250 on the HUI, and I like to start nibbling, 230, 225, and then get aggressive around 200. That's kind of how I've been doing it, because I just don't think that we're going much below 200. I mean, anytime you can buy the HUI under 200, I mean, for me, that's a steal. So that's where I'm accumulating. And so right now, I think we still have opportunity to buy lower. Like I said, I think Heckler will probably go back under $4 here, but maybe not. But yeah, these stocks are crazy cheap. The silver miners are crazy cheap right now. And a lot of the gold miners, they're not all cheap, but I would say, because I'm always trying to buy quality producers, at really cheap prices. And there's about 5 of them right now that, I won't buy because they're not cheap enough, but they might get cheap enough. We might have a 2009 event where everything is cheap. So I'd say Pan American. If Pan American goes sub 14, I don't think it will. But if it went sub 14, I think we would see, just about everything on sale. So I think low 14s is a good target for Pan American. It's trading in the 15s right now.
All right. And I have one small follow-up question when it comes to silver. So you were telling us, you can basically look at what's going on with gold and extrapolate that over to silver. I have heard some people express concerns about the outlook for silver given its industrial side and the possibility of going into a recession in the US or elsewhere. So what are your thoughts on that? How does that play out for you?
Yeah, I used to worry about that. I used to think in terms of the U.S. economy going into a severe recession, and that would basically decrease the demand for silver and create kind of a lid on the price. But I'm not in the collapse camp. I believe that we're in the muddling camp. And if we're in the muddling camp, muddling to me is basically no growth, zero, you're flatline. But even if you're flatline, you're still the demand is going to be enough to prevent that type of a scenario where the silver demand. So now I'm in the other camp. I'm in the camp that silver is going to outproduce gold. And one of the main reasons why is because there's just not going to be enough of it. And the reason why there's not going to be enough of it is because your retail demand and your ETF demand is just basically going to go bonkers. Think about silver going up from 30 to 50. When it goes up from 30 to 50, how much silver do you think the ETFs are going to need? It's crazy. They're not going to be able to find it. And so what are they going to do? I mean, it's going to be really interesting. I don't really trust SLV, but PSLV, they're going to go try to find that silver. And those are not the only two silver ETF. There's a few more. So the silver ETFs are just going to be soaking up silver. And simultaneous to that is your retail crowd. These are your Joe Sixpacks, the blue collar workers who basically can't afford a $2,000 ounce of gold. Well, maybe they can afford a couple of them, but that's about it. And now they want them, but they want to keep buying month to month. So they only want to spend maybe $1,000 a month or $500 a month. And so they go to silver. So gold's going to be the leader here. Gold is what, the big boys are going to buy on Wall Street. But everybody else, your retail crowd, they're going to be buying silver. And so last year we had a deficit of around 200 million ounces, which is crazy, right? Where did that 200 million ounces come from? Where's that excess inventory? If you go back when PSLV was created, they tried to raise, I believe, tried to purchase 90 million ounces of silver. Well, guess what? They couldn't. They got to about 60 million ounces. This was a few years ago. They got to 60 million ounces. There was no more silver to buy. So what they had to do is they had to just put in their orders and wait. And so that the final order, I forget how long it took. I think it took about 3 months for the silver to slowly start, coming in. And the silver that came in had dates on it of the year that they ordered it. It was silver that was mined after they placed the order. And that's kind of what we're in right now for silver. The silver above ground inventory, and I'm talking really about 1,000-ounce bars, which is that is what your fabricators need. And if people can't find 1,000-ounce bars, you're going to get a shortage. And I think that is what's going to happen, because the combination of your ETFs soaking up silver, and the retail crowd basically soaking up all your 10-ounce and 100-ounce bars. I think that you're not going to be able to find a 10-ounce or a 100-ounce silver bar or 5-ounce silver bar on the internet other than eBay, where people are charging, 40% premiums. But I think APMEX is the largest internet site. I think APMEX will run out. And when they run out, everybody's going to run out. And that is when silver is going to go kind of nuts. So the first run with silver from 30 to 50, this is where people always say, oh, well, $100 silver, no way we're going to get to $100 silver. Well, I just explained why it's going to happen. Once you get to 50, once a silver shortage happens, it's going to take a long time. It's not going to happen in 3 months. It's going to take a long time for silver supply to come back online in, say, like APMEX. APMEX is not going to get a bunch of silver overnight. And all the silver they get in is basically going to be on order. So what's going to happen is they're going to say, yeah, you can order it, but you're not going to get it for a month. And then once their silver inventory comes in, it's going to go out the door, in and out the door. In other words, they're not going to be able to build up an inventory for a long time. And so silver is going to go from 50 to 75 in like a month and going to blow people's minds. That's my feeling. 50 to 75 in a month. Now, this is predicated on this idea of a shortage. And so I don't know how long it's going to take to get to 75. I don't think we'll see it next year. I really don't. I think we'll see 50 next year, but I don't think we'll see 75, even though I say it's going to take a month. But I think that 7,500 is really 2025. And that's why I say you got to think long term. But I really feel that there's not enough shortage in the system. There's not enough shortage to handle basically a run to gold. It's not about silver. This has nothing to do with silver. Silver's just coming along for the ride. But the run to gold, which is what we've been talking about earlier, which is all based on this de-dollarization and based on this debt bubble that the U.S., this big economic problems the U.S. has, and that people, basically this fear trade that I think is going to ignite. The run to gold is what's going to push silver to the moon, not silver by itself. People buying gold, and then silver comes along for the ride, and then there's not enough silver. If enough people come along for the ride, again, I keep harping this, but if the ETFs, if they buy the silver that they need, because there's going to be so much demand into the ETFs, if they buy the silver, they're going to soak it all up. There's not going to be any inventory, and all it's going to take is one company to make an announcement, a news release, and say, we have to shut down our manufacturing plant. We can't find any silver. One news release will be all it takes. That'll be it. Because if one company says we can't find silver, what do you think will happen? I'll answer the question. They're going to hoard it. That's what happened with palladium. They ran out of palladium. There wasn't enough palladium. Nobody could find it. So what happened? They started hoarding. Palladium went from $150 to $1,000. That's what's going to happen with silver. One announcement. Can't find silver. Companies start hoarding silver. And everybody uses just-in-time inventory. So once they start hoarding silver, it's going to be, look out, Katie, bar the door, because the price of silver is going to go absolutely bonkers.
I think you can really start to see the interconnectedness of all the topics that we've been discussing today. So as we're wrapping up, just wondering if you have any final thoughts that you would add for our audience.
Let me think. I got to add something. Anything significant?
No pressure.
I think the one thing that I want to say here is I'm, nobody can predict the future. So even though I'm, bullish about where I see things coming, I could be wrong. I mean, the stock market, a lot of people think that 4,200 is going to hold, and that if 4,200 holds, I mean, we could see all-time highs by the end of the year. I'm not discounting saying that not going to happen. I just think my gut feeling says there's only like a 10% chance of that outcome. I see as a low probability, but again, I could be wrong. Nobody can predict the future. And people are going to go out there and, load up on silver miners because Don Durrett said they're going to the moon. This is all based on, guesswork and projections. Maybe I could be wrong here. The smart thing to do would be to wait and see if silver does go from 25 to 30 in a very, very quick manner, like I said it was going to, and then if you look at the silver chart, there's not a lot of support above 30. So the smart thing to do would basically be you'll be very cautious, not be this big speculator like me and be buying to the bottom and buying all these silver miners. The smart thing to do, if you're a conservative, if you want to sleep at night, is wait till silver, basically makes this big move, gold makes this big move, and basically get a list of stocks, get a plan, and then buy after the move starts. And so I think that I'll add that, just think in terms of nobody can predict the future. It's not 100% certainty. All I'm saying is that this is where I see the higher probability. And if I'm right, you can make a boatload of money in the miners. So Charlotte, thank you for having me on. I mean, this is a great interview.
Oh, thank you so much for coming on to talk about all these different subjects and for following me down all of my many questions for you. Great to have you here.
Thank you. Thank you.
Great. And once again, I'm Charlotte McLeod with investingnews.com, and this is Don Durrett with goldstockdata.com. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.